afternoon, everyone. My name is Ted Everett, and I'm a member of CFA Boston's Career Development Committee. I'd like to welcome you to today's webinar, a discussion of next generation investors featuring CFA Institute's Ryan Munson and Gary Mottola from the FINRA Investor Education Foundation. Truth in advertising, obviously, I am not in the Gen Z or Millennial cohort. However, our speakers today do know something about these generations. They've collaborated on a report about them and are here to share their insight. They may even share their own age cohort. Before I introduce them, I want to quickly mention two other upcoming CFA events. On May 14th is the half-day in-person Sustainable Investing Spring Symposium, ESG and Communications. The next day, on May 15th, is the Women's Initiative Joint Spring Networking Reception. This is an in-person evening gathering of 8 area women-focused financial service professional organizations. You can check CFA Boston's website for more detail. Now, presenting today is Gary Mottola, who is the Research Director for the FINRA Investor Education Foundation and a social psychologist with over 25 years of research experience. He oversees research projects aimed at better understanding financial capability in America, protecting investors from fraud, and improving financial disclosure. Dr. Mottola received his BA from the University of Albany, an MA from Brooklyn College, and a PhD from the University of Delaware. He is joined by Ryan Munson, who is research manager at CFA Institute. He is focused on the future of finance, exploring how extra financial factors impact our industry. He is the author of several CFA Institute publications, including The Future State of the Investment Industry, The Future of Work in Investment Management series, and the CFA Institute Investor Trust series. He holds an MBA and MS from Indiana University's Kelley School of Business and a BS from the University of Virginia. Now, before you ask, this event is being recorded and slides will be available later. Also, to post any questions or comments, please use the chat tab. Now, Gary and Ryan, over to you.
Thanks, Ted. And thank you all for having us today. Gary and I are excited to present some of the research that we've collaborated on and kind of get your questions on what factors of Gen Z and younger investors keep you up at night, and how we might be able to inform your position on the generation. So with that being said, I'll go ahead and get started on the presentation here. So really this research comes from a joint CFA Institute FINRA Foundation report that we published last year on Gen Z and investing. And it's a follow-up to the 2018 report that we also co-authored on millennials, and it follows a similar structure, trying to better understand what this particular demographic is looking to invest in, what are their challenges, what are their barriers to investing. And our goals for this research are really to understand Gen Z investing behaviors and how they might differ from other generations. We want to be able to inform the investment ecosystem, so that's you all that are participating in as advisors and as asset managers in the industry, on how Gen Z behaves. And then we also want to better learn how we can improve Gen Z financial knowledge, because we believe that knowledgeable investors are confident investors, and confident investors are more likely to participate in financial markets. So a little bit about the methodology for the report. We looked at 4 different cohorts. So we had Gen Z non-investors, Gen Z investors, millennial investors, and Gen X investors. And we looked at those investor groups, or non-investor group in one case, across the US, Canada, UK, and China. And you can see we have a breakdown of the participation numbers there. Relatively small survey. Today, we're going to be almost exclusively focused on the US group. But if you have questions on the other geographies, feel free to consult the report itself, or you can ask Gary or I at a later date. Okay, so to frame where we are in this research, we kind of need to define what we consider Gen Z and millennials. And I'm sure at this point we all have a relatively firm grasp of those demographics, but for the sake of this presentation and for the research, we define Gen Z as those who are 18 to 25. So they had to be over 18 to participate in most investing platforms. And 25 is the high end of the Gen Z age cutoff for this particular research. And we conducted the survey in March of 2023. So in theory, those 25-year-olds could now be 26 and still be considered in the same group. On the left-hand side here, we have a chart on the US population by generation, so you can kind of see where exactly Gen Z fits as we start to see baby boomer population rates decline. Gen Z is kind of taking up some of that slack. And on the right-hand side is an interesting chart, and it kind of helps to underlie why it's important to understand the role that Gen Z and millennials investors are playing in investment management in general. And so you can see that already over 30% of the inherited wealth is expected to go to millennials and Gen Z this year. And we expect that number to exceed 50% in the next decade. And so we've also seen from other research that millennials are expected to surpass baby boomers as the largest asset holding generation by 2035. So as baby boomers start to draw down their retirements and their pensions, and millennials continue to amass wealth, obviously we have the little blip here in the Gen Z, or excuse me, the millennial population. That transfer of wealth is happening most likely within the next decade. So some quick numbers on US Gen Z investors. 56% say that they own at least one primary investment type. So that's 401k, ETF, mutual fund, IRA, cryptocurrency. And 25% say that they actually started investing before they turned 18. And you can see $4,000 is the median amount invested. It's obviously relatively modest in the grand scheme of things. However, paired with the transfer of wealth that I mentioned on the last slide, and their continued emergence, if you will, from college and high school and entering the workforce, particularly for the younger Gen Z investors, we expect that number to continue to grow pretty quickly as they continue to advance their assets. Okay, so we know who the younger investors are. What are they investing in? And so here we have a chart that highlights the differences between Gen Z, millennials, and Gen X. And you can see that individual stocks, so the second grouping, and ETFs all the way on the right, are generally flat across all generations. But younger investors in particular are moving away from mutual funds and favoring cryptocurrency and NFTs. And I will make the caveat here that the survey might look slightly different today, perhaps drastically different. NFTs compared to a year ago are almost not talked about. And crypto, especially Bitcoin, I looked this morning, Bitcoin is up 240% over the last 13 months. So perhaps there would be more of an emphasis on crypto, just given the rapid growth that cryptocurrencies have experienced in the time frame since we conducted the survey. So now we take a look at kind of what the financial goals of Gen Z and millennials are. And you can see why they might be more interested in riskier classes of investments, such as crypto and NFTs. So most of the top ranked financial goals for those two generations are short term. So vacationing, establishing a safety net, paying monthly bills, and living and trying to get out of the cycle of living paycheck to paycheck. So they're not necessarily focused on long-term wealth generation. They're looking more at how can I get out of my current financial situation and using potentially riskier investments to change the direction of where they are today, rather than thinking about their long-term retirement or wealth generation solutions. So you can see a little bit, millennials slightly surpass Gen Z when it comes to retirement planning. Home ownership, they're neck and neck, so some of those more longer term goals, but for the most part, the things that rise to the top are short term. So we know who they are, we know what they're investing in, how confident are they in their ability to reach those goals. And overall, investors are fairly confident, especially millennials. But millennials were kind of well positioned to ride the wave of the post GFC, which may have bolstered their investment confidence. And you can see that Gen Z is actually pretty close if you include the somewhat confident buckets there, probably within the margin of error of the survey. This is contrasted with Gen Z non-investors. So one thing that we don't have on the slide here, but that we did survey, is we also surveyed that Gen Z non-investor group. And so those in that non-investor group, only 33% say that they are extremely or very confident in their ability to reach their financial goals. And 36 say that they're somewhat confident. So almost 20% say that they are not confident, of non-investors say that they're not confident in their ability to reach their goals. So a pretty significant difference between the investor group and the non-investor group. And one thing that's interesting about the risk appetites of younger investors, and plays into this idea of confidence, particularly with non-investors, is the idea of financial nihilism. And so basically, younger investors have a negative outlook on their personal financial future. This is the theory, and are foregoing long-term wealth generation planning in favor of higher risk, higher reward investments. So as we mentioned before, crypto, NFTs, that are almost more akin to gambling than investing. And so this is something that Larry Fink actually mentioned in his most recent letter to BlackRock investors. His concern on general apathy from younger investors. And it's a trend that's worth watching as more and more Gen Z turn 18 and have the opportunity and the ability to participate in capital markets. So not surprisingly, there are lots of reasons that young investors are starting to participate in financial markets, and the list is pretty varied. So you can see on the chart here that it's quite a significant amount of factors that play into the decision to start investing for many younger investors. And a lot of them are the results of technological advancements that have happened over the last 25 years or so. So when we think about things like the ability to start accounts with small amounts of money, fractional ownership, the ease of opening investment accounts, and the ability of financial information thanks to the internet and social media, which Gary will talk about more in the second half of the presentation. But those are all factors that are driving younger people to invest, which I think is obviously a good thing. That's something that we want to encourage. But there are some challenges when we think about how diverse this list is. So it ranges from parents and family, friends. There's some social pressures to invest. And so when you're thinking about how you as advisors, you as people who work in the financial industry are engaging with younger investors, there's not one direct solution that puts you into that source of influence in their lives. So the influences that they are receiving are broad. They come through many different avenues. And so the opportunity is there are lots of ways to connect with them. The challenge is there's not just one. So how do you kind of bridge that gap? And so the flip side of influence and confidence is the challenge to meeting financial goals. So here we have, what are the top challenges for Gen Z and millennial investors to reaching their goals? And you can see a few differences between the two cohorts. So for the most part, they align on those extrinsic factors, at least in ranking, that are out of their control as potential barriers. So things like the cost of living, inflation, economic conditions, even employment status. But millennials are more likely to face financial challenges around the cost of healthcare, potentially due to dependent care, and the cost of raising children. And so Ted mentioned whether we were going to divulge our personal demographics. I'm an older millennial and I have young children, and I can tell you that cost is quite significant, as I'm sure some of you know. So that's something that for sure is a barrier to many financial goals. But the one thing that I want to call out on the chart that is not really one of those extrinsic factors is an area that we as an industry can potentially eliminate as a challenge to investors meeting their financial goals, and that's the lack of knowledge about investing. So investors, which we have on the screen, Gen Z and millennials, but especially non-investors, say that a lack of knowledge is a barrier to their participation. And so that's an area that we as an industry are equipped to help. But it comes down to us kind of understanding that we need to meet investors where they are. So Gary and I can write a million reports and have them on PDFs on our websites, and they will not be read by the audience that we need to reach in order to close that gap on the lack of knowledge. So with that being said, I'll turn it over to Gary, and he'll run us through some insights on kind of where young investors are getting their financial information and where we can meet them where they are.
Sure, thanks, Brian. And I'll just get it out of the way. I may look like a boomer, but I'm actually an old Gen Xer. Have 4 kids, and they're all grown up. One is still in college, and she's actually coming home today. It's the end of her semester. So, but in any event, anyway, I digress here. We're going to talk about information sources. And so there's a lot of valuable information in this slide. I'm going to just focus in on a couple key points. So if you look to the left there on social media, so the way this is interpreted is the tall bar, 48%, is the percentage of respondents who cited that as a source. And the smaller number, the 12%, is the percent that say, well, they actually trust that source. So you could see across many of the sources, there's this there's this conflict between use and trust. Now, in terms of social media, there's not much of a generational difference there. Both groups are using social media. Trust is pretty low on both, but there are some generational differences that jump out. And parents and family, which is about three groups over, actually exactly 3 groups over, the millennials are much more likely to say, hey, yeah, I do rely on family and friends. I should say parents and family. And that's good. Although they only 27% say they trust parents and family. So obviously that's the highest trust level, but it's still a little surprising that only 27% kind of cite parents and family as a trustworthy source of information. It may be, as we're going to see in a slide or two down, it may be that they think their parents and family members don't have a lot of investing knowledge. So the other point I'd like to make on this slide is a little over to the right there. Financial. I'm sorry. Where is it? Yeah, it's pretty far to the right. The essential as a source of information, financial professionals, advisors, accountants, etc. And you can see a big generational difference here. Nearly 4 in 10 millennials are saying they use financial professionals for information, and the trust levels, very high. Actually, I think it is higher than parents and family. And you get a smaller percentage of Gen Z are saying they use financial professionals. Again, trust is high, and this makes sense. Gen Zs are younger. They may not have the assets to work with financial professionals. So just some generational differences there. So let's take a deeper dive on these information sources. You go to the next slide, Ryan. There we go. In particular, let's take a deeper dive on social media, because that is essentially the #1 source. And if you look on the left here, this is where we kind of went deep on what platform are you actually using. And YouTube jumped out. Not just in this study, we've done a number of studies, and YouTube is always at the top, and often by a wider margin than you see here. So YouTube is clearly the #1 source, at least in terms of social media, and so that's where they're getting their information from. I do want to point out Facebook. If you go down a little further, Facebook, you see a generational difference there. That's to be expected. The millennials who are older probably grew up with Facebook, and maybe some of the Gen Zers not so much. So we're seeing a pretty significant difference there. If we move to the right, I think this I really like this chart, because it's like, why do they trust who they trust on social media? And we were talking about this right before the seminar began. And if you look at those top 3 on the right-hand side, and by the way, they're pretty much the same for Gen Z and millennials. It's essentially be clear, be relevant, be transparent, and don't be salesy. That's essentially the formula that that these respondents are telling us in terms of who they trust and who they don't trust. One thing I found interesting was number of followers is way down low. I just assumed that would be a good indication of that the respondents would find the number of users, followers, as a metric to help them gauge trust, but does not appear to be the case. And, just one other point on this one. Investopedia as a source on the left-hand side there. Investopedia is all the way at the bottom, but we do see a generational difference. Millennials are more likely to use Investopedia. I just think that it's interesting because the Investopedia is a very reliable source of information, but it's way down low. So, okay, and you could go into the next slide. So we also asked respondents, how do you essentially manage your investments? And on the far left there, you can see broken out by generation. We actually have Gen X here, so go Gen X. And we see that, not necessarily surprising that Gen Z is much more likely to use investing apps to manage their investments, 65% compared to 55% for millennials and 38% for Gen X. Actually, what I find interesting about those particular numbers is that the Gen X number is pretty high. It's not nearly as high as the other two, but nearly 4 in 10 Gen Xers are saying they're using apps to manage their finances. So I think that is somewhat noteworthy. If we move to the middle one, how do you contact a specific financial professional? And essentially, we're seeing kind of generational differences there as well. Somewhat to be expected, but pretty stark differences that Gen X and millennials say, hey, I reach out to a financial professional to actually make my trades. Whereas that's much less likely if you're a Gen Z. Again, makes sense because Gen Zers are less likely to use a financial professional. So, and okay, so we could go to the next slide. Yeah, this slide, this is another one of my one of the slides I really like, because I think there's a lot here. So we were trying to get at this idea of gamification, right? On these mobile apps, you're probably familiar with the term gamification. Actually, another term is that the SEC uses is digital engagement practices. So we were trying to get at, are the investors, Gen Z and millennial, who are using these apps, are they kind of seeing what these apps are kind of putting out, and are they being influenced by them? So on the left there's just 2 pie charts. The percentage who had, we said, hey, did you get any recommendations on investments? And we could see nearly 7 in 10 Gen Zers, nearly 8 in 10 millennials say, yeah, I got a recommendation. which is good because they probably are getting recommendations, at least most of them, and they're noticing them. So that's a good thing. Well, I should say that's a good thing. They are noticing them, so let's keep it at that. And but what's really interesting is that it is among the people who said yes, I've received a recommendation, most are acting on that recommendation, right? So it's a 67% of the 69% who said they saw a recommendation said, yeah, actually I made a decision based on it. And again, the number is even higher for millennials. One reason I think this is interesting is because we work with a lot of market research companies, and I actually began my career in marketing years ago. So typically, when you ask people about the effects of advertising, they say, "Yeah, I saw the advertisement, but it didn't influence me." In other words, they kind of they kind of state their autonomy, like, oh yeah, I'm not influenced by commercials, I'm not influenced by these recommendations. But here we're seeing people saying, yeah, I saw it, and it influenced my behavior, which is a little different than what we see in kind of the more general marketing world. So gamification, it appears to be working. People are noticing, and people are behaving based on the recommendations that they get. So now we've been talking about knowledge and education, and one of the things we've asked is, all right, did you ever receive formal financial education or even investing education? And there's a number of places people can receive that. So we essentially asked them to break it out, and several things actually in this slide are noteworthy. One, across the top there, that yes, in school row, you could see that Gen Z investors and millennial investors and Gen X, it's kind of a linear relationship there. If you're in Gen Z, you're much more likely to say, yes, I received financial education in school. And in school, we mean essentially in America, we mean high school. And there's a couple of reasons this may be the case. One is that over the last, say, 10 to 15 years, more and more states have been mandating financial education in high school. So it is more likely that a Gen Z investor would have had to been mandated essentially to take a financial education class. And but another thing that could be affecting is Gen X investors, for example, they are older. They there's something when you're doing survey research called memory recall, that they may not remember actually taking the class in high school, because it was, say, 30 years ago. So that could be part of it. I do think for the most part that trend we're seeing is because of state mandated financial education. We see that people, the greatest source of financial or investing information is college. You could see across the board there for all those generations. So essentially, but there's always a caveat with this slide. That with education, you have financial education, and as the theory goes, the financial education is going to increase knowledge, and with increased knowledge, you're going to make more informed decisions, right? So this is just looking at the education piece. This is not looking at the knowledge piece, and this is not looking to see if financial education and increased levels of knowledge are associated with better financial decision making. We didn't do that in this study. There are studies that look at that, but I just want to kind of make that point that this is purely just about education. You can go to the next one. Okay, family dynamics. Yeah, I referenced earlier that we'll talk a little bit more about family. So here we have on the left, we said, hey, did your parents have investments? And we also said, did your parents talk to you about investments? And most, 68%, 64%, most said, yeah, my parents had investments. And by the way, Ryan mentioned that we did talk to Gen Z non-investors, and for Gen Z non-investors, the percentage whose parents had investments was much, much lower. So there's something going on here, which I'll talk about a little bit more about in a moment. Then we kind of asked them what we call in the kind of financial capability space, financial socialization. Did your parents talk to you about investing? And again, high levels of respondents said, yeah, they did talk to me about investing. Now, you're looking at this data, you could say, well, talking about investing is can be impactful in terms of getting somebody to start investing. And that's true, but there are some caveats here. One is this just could be an income thing, right? You know, if your family has a fair amount of money or wealth, you know, they may be able to kind of seed you for beginning to invest in the markets. If your family has a lot of wealth, you know, investments may be something that they kind of naturally talk about more. So in other words, just be careful about causality here. So yes, there is a correlation between your parents having investments and your parents talking to you about investments. That is, you are more likely to invest, but it could be driven by some factors that we're not observing here, like income and wealth. The slide on the right, I find it quite interesting as well, particularly, well, I should say the figure on the right, but let's focus on those two bars on the left of the figure on the right, you know, where you see 48% and 63%. So we asked the respondents, are you more knowledgeable than your parents about investing? Right. So 48% of Gen Z investors say, yeah, I'm more knowledgeable than my parents about investing. I mean, you know, Ryan showed a slide about confidence early on. This is a confident group because these are young people, these are young adults, right? And have a lot less experience than their parents, and they're saying, hey, yeah, I am more knowledgeable than my parents. Now, one interpretation that we've talked about is that if you're viewing knowledge about investments as, do you know how to use an app? Do you know how to use the internet? Do you know about crypto? If that's your frame for thinking if you're more knowledgeable about investing than your parents, then yeah, it may make sense that a Gen Zer says I'm more knowledgeable. But if you broaden the frame to other things like kind of what's a stock and kind of what's a bond and things like that, it's probably less likely that the Gen Zers actually know more than their parents. So you know, for the millennials at 63%, kind of, yeah, you know, makes a little more sense. You know, they've been around a bit longer, but yeah, that 48% of Gen Zers who say they're more knowledgeable than parents, I think that's interesting, but we think it's driven by crypto apps and kind of the internet, where they probably do have an advantage in knowledge there. And you can go to the next slide. This is just essentially a recap. I won't go into much detail here because, you know, we pretty much just covered it, but it is here just for your convenience. But I do want to talk a little bit more about the next slide, which is there's a couple pieces in there that you should probably know about. So the slide, the piece on the left, and these links, when you get the document, you can go straight to them. Obviously, the one on the left is the brief we've just been talking about. The CFA Institute released a great piece on finfluencers, and I could tell you it's great because in my world, it's widely cited. People have been talking about this since they released it. So definitely worth checking out. And the one on the right is a piece that the FINRA Foundation did in collaboration with a research center called NORC at the University of Chicago. And it's an interesting piece because it's longitudinal, right? So what happened was in 2020, when the markets, you know, when we had this influx of new investors into the market for a number of reasons, people were saying, who are these new investors? And what are they investing in? What are they doing? And we found out, yeah, that they're diverse. A lot of Hispanics and African-American investors. They're young, and they tend to invest in riskier products. And you know, they say that they don't use financial professionals, which again made sense because they're young and they didn't have a lot of assets. But then we returned to these same investors, these same exact investors. We came back to them 2 years later. And by the way, between 2020 and 2022, there was a big drop in the market. So we were kind of curious, you know, is this a generation of investors that's going to be turned off? They get in, there's a big drop in the market. Are they scared away from investing? And we found that, nah, they weren't. Nearly 8 in 10 were still investing. Their investing knowledge had increased a bit, so there's some experiential learning. But I think importantly for this group is that in that 2-year window, they were, 2 years after they started investing, they were much more likely to say, hey, you know what, I would use a financial professional. We don't know why it increased. We suspect that maybe some of these new investors thought this isn't as easy as it looks, particularly when you throw that the big drop in the market in there. So it's an interesting piece in terms of, in the sense that it's a longitudinal look at new investors, many of whom were Gen Z investors. And I think that is it. And that's all I have, but we're happy to take some questions at this point.
That's great. We were really a lot thrown at us there. We'll wait for some questions in the chat box, but I'll make a couple of comments. I think what was really interesting to me was looking at the assets folks are invested in, and I think this is my conclusion, but I think it really reveals their risk appetite. They're investing in crypto and they're investing in single stocks. And I think if you looked at those single stocks, you'd find those are probably meme stocks. So what they're really looking for is entertainment and high return. You mentioned earlier that gambling is something that this is akin to, and I think in some of your other research, you noted the rise of gambling. And one of the areas where you're really seeing sports betting is into the prop bets that are these turbocharged bets, where again, this financial nihilism is kind of, all right, I might as well bet the ranch and I'll just, throw a bet in and see. And so I think contrasting that with sort of set and forget in ETFs, which older generations might be doing, it really speaks to sort of the mindset of some of the of these investors. I think the other thing that struck me was that chart showing the trust versus source, where social media and internet, podcast, greatest usage but lowest trust. So, whereas parents and family, much higher trust, maybe not quite so much usage, and financial advisors come out okay. But I think when you talk about influencers in that report, they have an outsized influence on folks, yet I'm not sure they're really being trusted as to what they say as to how they use it. But some of the other questions, let me just see if we have any questions yet. Not yet, but I think what was interesting also in the sources of trust, what people were asking for, and Gary, you highlighted this, I think. Explain it to me clearly, make it personal to me, make sure it's relevant. All of that is storytelling on a personal basis, as an advisor saying, this is what I've done, this is how I've done it, and I'm not selling you anything. So I think as you're approaching this potential client, really think that through, rather than we will get you performance, blah, blah, blah. It's more, hey, you're saving for college, you're saving for whatever. You make it very relevant that way. I think the other piece was sort of the education piece, where everybody said they've had some education, but they don't trust it. So again, to your point, education is a huge opportunity for advisors, I think. And what I kind of draw out of that parental influence still is that if you can work with the parents to help them talk to their kids about stocks, that's going to really turbocharge that already strong relationship. Plus the fact that so many next generation investors are saying, I want nothing to do with dad's bank, and they want to go somewhere else. That's going to help cement that with all of that boomer transfer of wealth, I think. So, well, I've opined long enough. Let me just toss it over to you. So what do we make of all this? How do advisors reach out to this audience? Do we crank out the YouTube videos, or God forbid TikTok, if that's still available? What's your thoughts? What are your thoughts on that?
I can jump in first. I mean, I think and I alluded to this in my portion of the presentation, but the factors that are contributing to younger investors starting investing are varied. So there's family, and they're very similar to the sources of trust and sources of information that Gary mentioned. So family, there's technological advancements, and there's kind of formal education, and then there's advisors or financial professionals. And so if we think about those four different areas, there's a connection to family. So we've seen through Gary's presentation the influence that family has on getting the next generation to invest. And if we assume that, because like our data shows, the older you are, the more likely it is that you're going to have a financial professional, there's kind of an inroad to younger investors through their family particularly if their family is already working with a financial professional. So they trust their family, they trust financial professionals, and if their family already has a financial professional, then there's a pretty good inroad into to reaching that next generation. And then I think on the second thing that I would just call out is on the technology side. So I mean, you mentioned like, should we just be making an endless amount of TikTok videos? Probably not, because no one would watch them. But what I think that technology can be used for is, it's a medium for bridging the connection. So maybe there's a way to create understanding between yourself and your client because of something that you've consumed on social media, or you can steer them toward potentially a finfluencer, a financial influencer who has content that you believe is generally helpful and informative for your clients. So steer them away from these people who are focused on infinite wealth and these things that aren't actually real, and push them toward people who have good quality content that has a foundational base in traditional, financial management. And I think that can go a long way in establishing that trust. You don't necessarily have to be the creator, but if you can show them kind of the place to go, then I think that would be really helpful.
Yeah, and I'll add a couple points there. And I'm going to come at it from the regulatory perspective, but I think the regulatory perspective overlaps with kind of the financial professional perspective as well. So from a regulatory perspective, in order to essentially, protect investors, which is a big part of what FINRA does, you need to understand them. You need to know them. You need to know kind of demographically who they are. You need to know what their attitudes are, what they're investing in, kind of what their beliefs are. If you understand the investor, and you could create rules that are kind of tailored to protecting them. You could create education that resonates with them. So I think the same is probably true from a financial professional standpoint. That now I'm not a financial professional, so you guys might want to weigh in here. But I would think that you would need to understand your clients to both attract, I should say, understand potential clients to attract them, and understand your existing clients to serve them as best you can. So I think that's an important point here. Another is, and it's come up before, and there's that phrase which I don't like, but it's true. You got to meet them where they are. It's overused, but it is very, very true. And this is a challenge. And going back to the regulator side, this is a challenge for regulators. Regulators, typically have been hesitant to kind of go into the TikTok spaces and the Instagram spaces and things like that. Now, I think that's changing because, as Ryan pointed out, there's just a realization that if the educational content isn't there, they're not going to see it. So I know FINRA is looking into a social media presence that's probably more in line with Gen Z investors and millennial investors. So I think that's an important point as well.
Well, I think that's a good point. You look at meet them where they are. How do they consume information? To be honest, they don't read white papers. Even the advisors often don't read them, but they do consume a very visual bullet point sort of format. And so it's thinking about, I was joking about it, we all need to crank out YouTube, videos. It's like, well, there is probably some evergreen material that you can use as educational material. I think also keeping in mind that this generation is very much looking for entertainment as much as they are financial well-being in this. Thus, meme stocks or stories. Bitcoin is just something you talk about at the bar with your buddies when you're, playing trivia about how much you made, didn't make, or, what's going on with it. So I think there's an entertainment function that you have to kind of keep in the back of your mind. But to your point, education, I think, is really where we have an opening. Maybe you could talk for a minute. Let me just see if we have some questions here. I'm going to ask about finfluencers, and then I'll turn to a question we have here. I think you talked about it a little already. I think what's important is maybe you can focus on the risks that these folks present. I think some of the stats show that folks that are giving investment advice very often are pitching something or have an affiliate link or some connection to a product they're selling, and sometimes they're not even aware that they're really selling it but are connecting to it anyway. And I don't think folks really see that when they pull up one of these accounts. Maybe you could talk about that a little, either of you.
Yeah, again, I'm happy to kick it off. You know, I think that really is the big challenge with influencers is there's not the I mean, Gary's the regulator, so maybe I should let him speak. But I think that it's just really tricky when you think about jurisdiction and kind of the, you know, we have like the marketing rules that we have for a reason, but they don't necessarily extend to individuals, at least not in this case. And so trying to understand, you know, how we can better put these safeguards on, and who's even responsible for putting the safeguards on in the finfluencer space is something that, quite frankly, I mean, in our report, we make some recommendations for how firms should engage with influencers who they're using through as a marketing arm. But obviously, there's a little bit more of a regulatory compliance aspect for firms who are employing influencers than ones who are operating as individual agents who are getting kickbacks on referral links and you know, getting people to sign up for investment accounts that maybe they don't have any business signing up for.
Yeah, I'll just add, and I agree with Ryan's take. I'll just add, this is a significant challenge for the industry, right? It's, first of all, just try to define finfluencer, right? If you had to get a very specific definition of influencer, you know, people would come up with very different answers. So it's hard to kind of regulate something that is nebulous, like what is a finfluencer? Now it's something that, you know, FINRA and other regulators are aware of. So you know, we're kind of addressing this, but that's that's a potential problem. You know, and an example is, you know, what we're seeing is kind of indirect finfluencers, right? So, you know, it's a cooking show, right? So you're watching a cooking show, and all of a sudden, you know, the person will start talking about crypto and say, hey, you know what, you can get crypto here. You know, I'm not sure how the compensation works, but I think there's some type of compensation involved as well. So is that cooking person a finfluencer? You know, just to kind of emphasize the challenge we have, you know, when we try to research kind of influencers, we're not even sure we could use the term influencer. Like if you're talking to what we call the general population, adults 18 and over, yeah, the younger ones will probably have heard the term influencer, but would a 30-year-old, 40-year-old, 50-year-old, if you said, you know, do you watch any influencers, they might not even know what you're talking about. So I'm just kind of highlighting some of the challenges that we face, and you know, smart minds are tackling it. But it is something that I think we all need to keep an eye on.
I think another aspect of that is there's no geographic limitation. When you get information on the internet, it comes from anywhere. And so some of these folks are not beholden to US regulatory rules or don't feel they need to pay attention to them. And so I think, again, the educational opportunity here is how to teach younger investors how to be good consumers of information. I mean, that's true of internet information generally, but and that's a bigger battle. But
yeah, well, I think just to jump in, I think that there's somewhat of a positive picture that Gary spoke to on the difference between the usage of social media and the level of trust in social media for financial information. So I think the number's 48% use it and 12% trust it for Gen Z. And I think that that's kind of a byproduct of Gen Z growing up in this era of being constantly bombarded with information. And I think they're pretty well equipped to sort through that and figure out what is and isn't you know,
right.
real information relevant to them.
There's an inherent,
much more so than like my parents or my sole remaining grandparent, who every time the phone rings And as a telemarketer, she thinks they're calling directly to her and not just using a scattershot
Right.
approach.
So there's an inherent cynicism in this generation that gives them a little bit of a leg up, but still teaching them that this, the whole idea that these incentives are not transparent and can have a real effect on that sort of on the level of that advice. We have a question here, and it's a little complicated, but I'll read it off. It's, when it comes to market or asset class volatility, are there discrepancies in confidence levels over time between the different generations, Gen Z, Millennials, Gen Xers? For example, Gen Z investors experience larger swings in being confident than other investors through big market drops and rallies. Do they react differently when you take the snapshot? They seem like they know what they're doing. They're very confident. Does this change at a different level than others? If I'm reading that question correctly.
In this particular report, we didn't necessarily ask that question. And there is one kind of analog that I have from a previous CFA Institute report. It's the Investor Trust Series. And we wanted to know, the Investor Trust Series kind of looks at broadly 15 different markets and just general consumer sentiment for the investment industry. And we had this theory that trust went up when markets were good and trust went down when markets were bad. And thankfully, or I suppose thankfully, we did not find a correlation between market performance and level of trust in the industry. And that was across generations. So the last time we did that study was in 2022. So not too many Gen Zs probably participated, but certainly Millennials and Gen X, there was a low correlation between performance and trust in the industry. So not necessarily fully answering that question, but perhaps directionally adjacent.
Yeah, one thing I'll add is, and Ryan hit on this a bit, these younger Gen Z type investors have shorter time horizons. They're willing to take more risk. They have different goals, including entertainment and even gambling to a certain extent. If that's what's driving you, volatility is a good thing, right? That you need volatility to essentially have that gambling aspect to it and to get the excitement from it. So early on, we did a study on volatility, and we did find that volatility was one of the things that was bringing people into the market. One, they were hearing about the market more because it was volatile, so it was kind of top of mind. So I suspect it's not a direct answer to the question, but I suspect there are generational differences in terms of how the different age groups perceive volatility and either want it or don't want it. So.
It's the triumph of youth over experience. What could go wrong? So, okay. We are coming up on the hour. Fidelity did a report recently sort of addressing this, and they had some interesting observations of kind of how to deal with it. I'm going to see if I can. All right, I can't do it. I was trying to put a link in the chat here, but it's called "It's Time to Change Your Mind About Young Investors." It's a white paper from Fidelity, and they walk through in greater detail kind of how to reach some of these folks. So I just throw that out there in addition to the resources that we have already put out or will be available in the slides when we get.
And Ted, I know we're out of time, but there is one comment one area we didn't hit on. I just want to mention, and in our research, we found like you do have to be careful with how you communicate with the younger investors, because they can often they perceive it as condescending. Oh, you're telling me not to do this and not to do that because that's the way you did it. Well, things are different. So, we're careful in our communications not to come across as condescending, but just to kind of come across as informative. And that might be something you want to keep in your back pocket as well as you're thinking about and interacting with younger investors.
Well, I think it comes back to share your personal experience with me as one of the factors. Okay, you made a bad trade, you made a stupid mistake. Share it with me. Show me you're human, and explain what that says about the decision-making process, so you might, benefit later. So, okay, it looks like we have a link to that report in the chat box. Thank you, Todd. no, but you're right. This is a cynical group that always looks askance, as any parent will tell you. You never know what's going to stick, and you'll see it 10 years later. So, good. Well, we are coming up on the hour. I appreciate everybody spending time with us, and the great insight we've had here. Unless there are any other questions, I will give you back 2 minutes of your day. So again, I want to thank you guys for presenting today. This is great. And again, there are those 3 reports that are good follow-up, granular detail. I know someone was asking about some of the survey parameters itself. All of that's in there. So the gory detail. So with that, I think I will wrap it up and thank you guys again and wish everyone a good day.
Thanks, everyone.
Thanks.